Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Comfort Systems USA Inc. quarterly report. Comfort Systems USA Inc. provides a wide range of services to various industries across the United States. The company operates through two main segments, mechanical and electrical. In the mechanical segment, they offer heating, ventilation, and air conditioning systems, as well as plumbing and piping services. In addition to these core services, Comfort Systems USA also offers off-site construction, monitoring, and fire protection services. They are involved in designing, engineering, integrating, installing, and starting up mechanical, electrical, and plumbing (MEP) systems for new buildings. For existing buildings, they provide renovation, expansion, maintenance, monitoring, repair, and replacement of systems. The company also offers remote monitoring services to track power usage, temperature, pressure, humidity, and airflow for MEP and other building systems. Their clients include building owners and developers, general contractors, architects, consulting engineers, and property managers in the commercial, industrial, and institutional markets. Comfort Systems USA, Inc. market capitalization of $61 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Comfort Systems USA, Inc. holds a significant advantage in their industry. Comfort Systems USA, Inc. trades at a higher price-to-earnings ratio of 50 times and a higher price-to-book ratio of 94.04 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. At the same time, profits have grown exceptionally fast while the share count has declined. This suggests management is generating substantial earnings while actively concentrating value into fewer shares, an extremely positive signal for long-term investors. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in billings that exceed costs and estimated earnings, as well as deferred revenue, has contributed significantly to revenue growth. This is evident from the substantial jump in revenue from $1,831,286,000 in 2025 to $2,865,332,000 in 2026. Furthermore, specific segments have shown remarkable growth. The mechanical segment has seen a 47.5% increase in revenue, while the electrical segment has experienced an even more significant surge of 87.4%. Additionally, technology customer type revenue has increased by 138.6%, and new construction activity type revenue has risen by 100.3%. The company's contract liabilities have also shown a notable increase from $2,120,262 in December 2025 to $2,345,279 in March 2026. This indicates that the company has secured significant contracts, which will contribute to future revenue growth. On the other hand, the primary drivers of revenue decline are more nuanced. A decrease in inventories and prepaid expenses and other current assets have contributed to a reduction in revenue. Additionally, net cash used in operating activities has been substantial, indicating that the company may be experiencing operational inefficiencies or increased costs. The net income of a company underwent significant fluctuations between 2025 and 2026. Initially, it increased by 118% from $169,289 to $370,378. However, this growth was followed by a substantial decrease of $105,314,000 in the previous year. In contrast, there was an increase of $274,134, 31.7%, from 2025 to 2026. The profit margins also experienced changes during this period. The gross profit margin remained relatively stable at 26.2% and 26.3% for 2025 and 2026, respectively. On the other hand, the operating profit margin saw a notable increase from 11.4% to 16.9%. This growth continued in 2026, with an increase of 5.5 percentage points. The reasons behind these changes can be attributed to several factors. The company's revenue grew by 56.5%, driven by same-store activity and acquisitions. Additionally, strong market conditions, including increased backlog and demand in the technology sector, contributed to the growth in net income and profit margins. The company's financial performance indicates a positive trend in its operating cash flow. According to various sections of the report, it is clear that the company is generating significant amounts of cash from its operations. On page 9, the net cash provided by operating activities is reported as $388,828, which is a positive indicator. Furthermore, pages 25 and 26 explicitly state that the company is generating positive operating cash flow. Additionally, page 31 confirms this trend, providing further evidence of the company's ability to generate cash from its operations. Overall, these findings suggest that the company is successfully managing its finances and generating sufficient cash to support its business activities. The company's debt level has undergone significant changes over the past year. Initially, long-term debt decreased from $139,063 to $39,054, indicating a substantial reduction in debt. This trend is consistent with the overall decrease in total debt from $145,226 to $39,079. However, it's worth noting that letter of credit commitments have increased to $82.8 million as of March 31, 2026. In terms of interest expenses, there appears to be a mixed picture. On one hand, interest expense increased from $1,619 in 2025 to $2,178 in 2026, suggesting an increase in debt-related costs. On the other hand, interest expense decreased by $559,000, minus 34.6%, at some point, indicating a reduction in interest expenses. This discrepancy may be due to varying time periods or specific circumstances affecting the company's financials. Management is projecting a high-demand environment for manufacturing and technology customers over the next few years. Despite cost pressures and supply chain delays, revenue growth is expected in the near term, driven primarily by project-based installation services. The company aims to continue growing in commercial, industrial, and institutional markets while maintaining profit margins that reflect the value of installed systems. To achieve this, management plans to focus on improving execution in operations across multiple locations and investing in operating unit management quality and stability. However, a potential risk to revenue and profits is an interruption in bonding capacity, which could impact the company's ability to secure necessary financing for projects. Despite having a plan in place to respond to such an event, management acknowledges that it may take time to effectively address this issue. The company has a history of buying back its own shares. According to the provided information, the company has made significant share repurchases in recent years. In 2025, it bought back $91,369 worth of shares, and in 2026, it purchased an additional $2,548 worth of shares. This trend is consistent across multiple pages of the report, with the cumulative total of shares repurchased as of March 31, 2026 being reported at 10.9 million. The company's share buyback program has been ongoing for some time, with a significant number of shares being repurchased in recent years. There are growing concerns about inventory buildup and supply chain disruption. The construction industry is facing intermittent delays in delivery of certain materials and equipment, as well as supply chain shortages and delays. This has resulted in shortages of labor and specialty building materials, leading to increased costs for materials and difficulty in obtaining or affording bonding and insurance. The impact of these disruptions is multifaceted, affecting not only the construction industry but also the broader economy. The inability to obtain necessary materials and equipment is causing project delays and cost overruns, which can have far-reaching consequences. Furthermore, the strain on supply chains is likely to continue unless addressed promptly, exacerbating the existing problems. The situation highlights the need for proactive measures to mitigate these risks. This may involve diversifying suppliers, investing in inventory management systems, or exploring alternative materials and equipment. By taking a proactive approach, construction companies can minimize the impact of supply chain disruptions and ensure that projects are completed on time and within budget. And that concludes the financial summary for Comfort Systems USA Inc. Feel free to comment below, and I will be happy to answer them when possible.